Hello, very good morning to all, and welcome to today's Daily Dose of Market Insights. I'm Kelvin here. Well, today will be Tuesday, the 8th of October 2024. So let me do a mic check first. Is it okay? Yeah, good. I think all is good. The screen is okay to see because there's some technical issue early on this morning. All right, so very good morning to all. Welcome to today's Daily Dose of Market Insights. Kelvin here again. Today will be Tuesday, the 8th of October, 2024. So before we jump straight into our daily dose or our gist of today's daily dose, let's have a quick look at the disclaimer first. All right, leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exceed deposits. This presentation is not an offer or solicitation to buy or sell or recommendation for any investment product, as well as any forecast, prediction, projection in this presentation is not necessarily indicative of the future or likely performance of the product. This advertisement has not been reviewed by the Monetary Authority of Singapore. All right, so before we jump straight into the short-term intraday technical outlook, let me cover what has taken shape yesterday and as well as what has taken shape today as well, because there's a very volatile session, especially on the Hong Kong stock market due to this ongoing briefing by the NDRC, which is the China top policy economic making body. All right, later I'll share more about that. So before we jump into the gist of the China related stock market, let's have a recap what has taken shape yesterday in the US session. So during the US session, there's actually no major news release except for a slew of Federal Reserve officials speaking. So nothing pretty much new. Everything still boils down to data dependent. But I want to highlight over here is that due to the rise in oil price yesterday, because oil price yesterday added by another. Okay, let's look at the chart of oil price. Okay, over here. Let's jump straight to the oil price first. Okay, so oil price yesterday, let me go down to the daily chart. Okay, so this West Texas oil. So West Texas oil yesterday added another 3.67%. Okay, 3.67%. So net overall, since the low of 1st of October last week, oil price over here. Let me share with you the chart of oil price, the percentage gain. Okay, since the low of 1st of October all the way up to yesterday high, Monday high, total gain is 16%. So with this sharp rise in oil price over here, it actually increased the inflation expectation in the US. Why? Because oil, later I'll share the fundamental, there's this intermarket fundamental dynamics pertaining oil price and how does it impact inflation expectation, then together with the headline inflation thereafter. I'll talk more about that. So with this increase in inflation expectation, it pushed up the 10-year US Treasury yield. So if you look at the US 10-year Treasury yield over here, okay, this is the US 10-year Treasury yield. Okay, on the daily chart. So yesterday it pushed up to the 4% mark again. Okay, so it has a closing price of 4.03%, and right now it's actually slightly inched down lower to 3.99%. So previously it broke down below this 4% psychological level in July. So this is the first time since about we talk about 3 months back, it managed to go up to that 4% level again. So you know that the US 10-year Treasury yield is also be used as a proxy of inflation growth and as well as economic growth. That means, i.e., if economic growth starts to improve in US, that is being shown on the non-farm payroll data on Friday, it will actually lead to we call it a stabilization or an uptick in inflationary growth as well. So with this inflationary growth coming back into the picture, that's using that US 10-year as a proxy, that actually reduces the amount of mega interest rate cut that is being priced into the market. So let's look at the CME Fed Watch 2 over here. So for those who actually first time joining us in our daily dose of market insights over here, we can use this CME Fed Watch 2 as a gauge based on the data is being compiled by the Fed Funds futures market Okay, that means CME Fed Watch 2 use the 30-day Fed Funds futures to give a gauge what is the current market expectation on future FOMC meeting. Because we know the FOMC meeting, the Fed will either hike or cut. So this particular CME Fed Watch 2 will give us a probability based on the latest pricing on the 30-day Fed Funds futures, taking into account of the latest economic data that what market is actually expecting. So we know that the current Fed Fund rate is 4.75% to 5% after that 50 basis point cut last month. So for the month of 7th of November, that is the next meeting. So the next meeting, right, market now is actually pricing in almost 86% chance that there's only 25 basis point cut. And right now there's a slight increase of 40% chance that the Fed will hold at 4.75%. And that 50 basis point cut has been reduced to 0. You could see over here. So let me expand my screen so that you guys could see much clearer. All right. So notice that previously 1 week ago, there's still a chance of 35% chance of a 50 basis point cut. So how do I know 50? This is the ending Fed funds rate at the end of the meeting on 7th of November at 4.25%. So for the current rate is 4.75. So for 4.75 to 4.25% is an implied 50 basis point cut. So in the current Fed funds futures market, looking at the Fed funds rate to end at 4.25% on the 7th of November meeting, is 1 week ago it was 35%, and based on the current futures pricing right now is 0%. That means market has now almost reduced the chance of almost close to nil that there will be no 50 basis point cut in terms of the probability we're seeing right now in the CME Fed Watch 2 on the 7th of November meeting. So market is now skewing towards 86% chance that the Fed only cut 25 basis point. And what's surprising over here is that there is a slight pricing of 14% chance that the Fed will stand pat. That means they will not even cut rates, but that only stands at 14%. But that has been greatly increased from a probability of 0 that was 1 week ago. Now we have 14%. And how about the next meeting in 18th of December, 29th of December, 19th of December, stretching all the way up to 1, 2, 3, 4, 5, 6, 7, 8, 9. 9 meetings all the way down to 10th of December 2025. So we can look at the aggregated probability over here. Okay, so based on this aggregate probability, previously in the December meeting, there was a chance of a 50 basis point cut to bring it down to 4% slash 4.25%, but that has been greatly reduced as well to only 4% chance. So what market is now expecting is 25 basis point cut on the 7th of November FOMC meeting. That's pretty high at 86%. And after that, another 25 basis point cut to bring it down to 4.25% before 2024 ends on the 18th of December FOMC meeting. So that's has a high chance as well of 96%. Then in the new year, on the 29th of January 2025, another 25 basis point cut to bring it down to 4.4% to 4.25%. So you see a series of 25, 25, 25. So whatever another mega cut of 50 basis point cut has been greatly reduced. All right, based on that very strong non-farm payroll data and also the current push up in the WTI crude oil price due to rising geopolitical risk premium triggered by the ongoing increasing hostility in the Middle East region. That means right now there's no clear signs of a diplomatic de-escalation right now that causing oil price to go up as well. That has a increase in future inflationary expectation that could prevent the Fed from engaging a deeper 50 basis point cut that previously the market kind of priced at a higher probability last week. So even if you go down to the rest of the new year FOMC meeting from March, May, June, July, September, October, market is expecting it to stand pat for the next 2 meetings in 19th of March and 7th of May, because there's high odds of 74% chance and 67% chance that it will remain stand pat at 3.75%, and another 25 basis point cut, then standing pat again in July, another 25 basis point cut on the 17th of September, then standing pat on the 29th of October. So by the time it reached the 29th of October 2025 FOMC meeting. So that's about a year from today. Means a year from today, market is expecting the Fed funds rate to be reduced to 3.25% to 3.5%. So overall, that's only about 2% cut if you take into account of the start of the interest rate cut cycle last month. Okay, so previously market is looking at much more deeper cuts to bring down to around 3% to 2.75%. So that has been greatly reduced. So with this kind of interest rate cut magnitude has been reduced by the pricing of the Fed funds futures contract compiled by the CME Fed Watch 2 due to rising inflation expectation due to higher oil prices, that causes a kind of an intraday negative feedback look into the major US stock indices yesterday. So across the board, we start to see the SPX, the Nasdaq, the Dow Jones, the Russell 2000, all of them decline, with the higher beta Nasdaq 100 performing the worst, negative 1.17% yesterday. The S&P declined negative 0.96%. The Dow Jones negative 0.94%, and the Russell 2000 negative 0.89%. So if you look at the heat map of the S&P 500, almost all the mega caps stocks are in the red. The mega 7 cap stocks are in the red. Apple down negative 2.25%. Microsoft down negative 5.7%, followed by Google down negative 2.5%. Meta down negative 1.9%, and Amazon down negative 3%. So far, the one that is holding the fort is Nvidia, positive 2.24%, but it cannot actually cause the Nasdaq 100 to flip into a positive territory yesterday, because the rest of the other 4 mega cap stocks in the technology space has actually tumbled much worse in terms of the magnitude. So if you look at the groups itself, the sectorial performance, so based on the one-day sector performance, all the sector are actually in the red. Almost all the sector are in the red over here, with only the energy sector managed to actually, where we are, let me go back down again. Only the energy sector managed to actually inch a positive gain of 0.5%, positive 0.48% to be precise, due to the rally in the oil prices yesterday, because oil price actually moved in correlation with the energy sector on the S&P 500. So bear in mind, for those who are first time see this, this actually is a breakdown of the 11 S&P sector. All right, so what I want to share with you all is that all the sector are in the red. The only one that is bucking up the trend yesterday was energy, due to the rising oil price. So what we see over here is that this oil price over here has an impact on the major US stock indices. So we got to monitor the oil price right now to actually have at least a gauge on where the US major stock indices are heading on from a short-term to medium-term perspective. All right. So if you look at the FX market over here, so the FX market, let me share with you what's going on in the FX market. Yeah, this is the FX market. So the FX market over here is more like a sideways performance. So this is a 5-day rolling performance of the US dollar against other major currency, with dollar strength plummeting against the dollar yen. So that actually came down within our expectation as well, because the dollar yen hit kind of a medium-term pivotal resistance level at around the 49 handle. Without touch on you guys again, we are covered on the intraday technical outlook. But the dollar starts to actually be pretty much firm against the Aussie and against the Kiwi based on yesterday's performance as well, but rather mixed against the other currencies, because other currencies try to go sideways. So against the dollar Swiss, against the dollar sterling, the dollar CAD, the dollar Swiss, the dollar euro, and as well as the dollar CNH. Okay, so others sideways at this point in time. And what you could see over here is that during the Asia session right now, the Hang Seng index, all of them actually closed in the red, a bit of profit taking, down negative 5% on the Hang Seng index. The Hang Seng Tech down negative 7%. So this is considered as the China Big Tech. The HSCEI comprises of the H shares or the A shares that are listed on the Hong Kong Stock Exchange, called the H shares, down negative 5.6%. and we see the the China stock market reopening after the 1 week golden break, but their probability also starts to actually close down as well. So if you click on it over here, okay, you see this is the China CSI 300. Initially it spiked up, and now some of the gains managed to actually reduce as well, as due to this ongoing speeches by the NDRC. So what is NDRC over here? So this over here, this economic calendar, right now at the start of 10 a.m. actually they are still speaking. I think the press conference is still going on right now. Later I'll pull over to share what are the key points that's being shared. So it's the National Development Reform Commission briefing. So this particular body is actually being tasked to actually dictate out economic policies. Okay, economic policy, it can be especially fiscal policy over here. So there was a briefing that's being held on 10 a.m. Singapore time, and you will still recall that what causes the China stock market and the Hong Kong benchmark indices, the Hang Seng indices, rallied very strongly, about 20% to 30%, depending on taking from the low of September all the way up to last week, is due to this very forceful messaging that is being laid out by the Political Bureau meeting before the Golden Week holiday. So that was end of September. So the wording of that meeting, so Political Bureau meeting is a meeting between the top 12 key leaders of China. They will sit down together every month to discuss about policy, economic policy, and foreign affairs policy. And on September, they actually formed the meeting. At the end of the meeting, they issue a very strong statement that they will stop the fall of the China property market, the prices of the China property market, that is causing the crux of that deflationary risk spiral in China. And there was actually also a potential issuing of what additional 1 trillion worth of fiscal policy. That means market is now looking at a more forceful fiscal expansionary policy rather than the piecemeal one that was actually implemented in the last 2 years or 1.5 years. So right now, market is now looking for a more, we call it a forceful expansionary fiscal policy that directly target consumer spending, to hopefully in a way to improve consumer confidence to address this or to negate or stop this ongoing deflationary spiral in China. So market actually rallied because of this, market as in the China A share market and the Hang Seng indices. So this morning, let me pull up the other screen now. Okay, so this is what occurred. Okay, so this was the briefing so far. Okay, on this live report from Bloomberg over here. Okay, let me refresh it. Okay, I think the briefing is still ongoing. Okay, it's still ongoing. Okay, so okay, so far, right, there is no clear signs of any. Okay, wait, let refresh for a while. I want to share with you some of the headlines that being reported by Bloomberg over here. So hopefully things get better, because I don't know why every time when I do this go to webinar, things tends to be slower over my end. Okay, let it refresh for a while. Okay, my apologies, because I need to share with you the latest headline. Because some of the headline over here is that there is not much of a clear rhetoric that the kind of forceful policy that is being market is expected, that is being announced in the briefing. So far the headline was rather brief. There's no really kind of very clear, concrete we call it plans that market actually wish to hear instead. Okay, so okay, gosh, it's still not picking up. I don't know what's going on. Okay, it's still not picking up because I think it's hanging right now, because it's a live headline over here. Okay, let me try something. Okay, so basically, right, this is so far what is being. Okay, good. Okay, it's coming up now. Okay, gosh, it's still not showing. Okay, so let me share about this thumbnail over here. So let me expand my screen. Because so far what was being shared over here is only this particular statement to issue 100 billion yuan worth of investment plan over here. So initially market is looking at this 1 trillion yen instead, right? So there is no, even though this 100 billion yen worth of investment plan, there is no clear-cut direction of where this 100 billion yen is being earmarked to. That means whether is it to boost consumer spending or some form of corporate subsidy. So this is pretty much unclear. And also this mentioned very vaguely, saying that China to issue ultra long sovereign bond in 2025. So what this imply over here is that that 1 trillion so-called additional stimulus that's being rumored last week is being kind of much more pushed forward to next year instead, because of this issuance of this ultra long sovereign bonds, which is likely form the bulk of that additional 1 trillion stimulus. And there's some encouraging sign. This NDRG's chief saying that China is confident of achieving targets. So it's that so-called 5% year-end 2024 target that is being stipulated by the top China policymaker at the start of this year. He also gave a bit of what I call a soothing message, saying that China economy is stable. So that's why, due to this lack of clarity, number one, this year, that means this year, instead of 1 trillion yen, it's about 100 billion yen. So the remaining of it, that means 1 trillion minus 100 billion, will go into next year due to this ultra long sovereign bond issue in 2025 instead. And out of this 100 billion yuan worth of investment plan, there is no specific that is being spelled out yet so far in the press conference that is going right now, because I can't share with you all the live bullet points that are showing, because it's remained hanged at my screen right now. So what you could see over here in terms of the market reaction is rather negative on the Hang Seng Index. Okay, down negative 5% and down negative 5.8% on the Hang Seng indices, and the HSCI is down negative 6.5% so far. Right, so later I'll touch on more on the intraday technical outlook on the Hang Seng indices, and it's now also spilling over to the rest of the Asia indices as well, with the Nikkei 225 down negative 1.2%, and the STI, the other Southeast Asia currency, is also down a fair bit as well, with the STI down negative 0.25%, the KLCI down negative 0.18%, and the Thai index down negative 0.21%, and even the KOSPI is down negative 0.7%, and the Taiwan benchmark index is down negative 0.74%. Down this negative 0.92% right now. So there's a negative intraday spillover effect right now due to the weakness that's being seen on the Hang Seng indices, due to that so-called not so anticipated forceful announcement that the market wants to hear, but instead the NDRC painted a kind of a vague picture in terms of the upcoming fiscal stimulus plan that is going to be announced in China, that's going to be enacted in China in the months ahead. All right. So right now, let me share with you the short-term. Before I talk about the short-term intraday technical outlook, there's a fair bit to cover today. Is this impact on oil prices that could have on the future inflationary expectation in US? So that should explain why the interest rate cut in US so far has been priced by the CME Fed Watch 2 has started to tone down. So this is the chart previously I shared with you all in one of my daily dose as part of the fundamental and intermarket dynamics. So we know that on September, the first week of September, the Fed starts to cut interest rate over here, which bring the Fed funds rates down from 5.21% down to this level over here. All right. At 4.83. This is the 4.75% and 4.83. This is live, but this is traded in the market, so it's 4.83%. Okay, but what's interesting over here is the WTI crude oil price in blue. So you realize that the WTI crude oil price has started to rise. Okay, and this rise in WTI crude oil price was pretty steep in the last 1.5 weeks or so. That what causes the US 10-year break-even inflation as 5-year break inflation rate to increase as well, okay, to jump up as well, right, to jump up. So it is considered a big jump in the last month or so. Previously, it was actually hovering very close to the 2% level, that is very close to the Fed long-term inflation rate target. So view this as this 5-year break-even inflation and 10-year break-even inflation is a market transacted instrument based on the TIPS, the US Treasury Inflation Protected Securities, is derived from there. It's put in a nutshell is what inflation will be 5 years from now and 10 years from now. So that's called inflation expectation based on tradable instrument, and it moves every day based on the latest supply and demand dynamics of the current factors that's impacting this break-even inflation, and is primarily driven by oil price. So you look at in the past, right, based on the last 3 years or so, previously there's this spike up in inflation expectation, the 5-year and 10-year is driven by the spike up in oil price as well. And prior to that, we know that this scare of this deflation scenario due to the pandemic, the oil price also fall, and so lead to the fall in the 5-year and the 10-year break-even inflation. So given that this 10-year and 5-year break-even inflation starts to rise, it also impact the US 10-year Treasury yield as well. All right, so the movement over here is that if oil price continues to increase higher and higher, there is a big risk that inflation expectation will increase, and that will actually cause US inflation pressures to come into the market again, and that could potentially prevent the US Federal Reserve from having a difficult time to enact an interest rate cut cycle next year. So perhaps they may start to pause, and who knows, if oil price continues to go up, later I'll share with you what is the key we call it resistance level to watch in oil price. Going to go up higher, there could be a chance that the Fed could to force to come into high rates again, okay, to address heightened inflationary pressure reviving into the US economy. And how do we see that is by looking at another chart. I believe that this is the first time I share about this chart over here. The top of the chart is a market traded ETF called Invesco DB Commodity Index Tracking Fund. DBC, the ticker, is listed in the New York Stock Exchange, if I'm not wrong, US New York Stock Exchange. You just type in DBC, you're able to obtain this price. So this DBC, right, consists of all the traded commodities in the market, in the futures market. That means it could be copper, it could be gold, silver. That means it's precious metal, industrial metal, and energy. And a significant percent, I think close to about 60 to 70%, is heavily weighted according to energy products. That means energy futures, WTI crude, Brent crude, and gas prices. So there's a key support level over here that this index managed to hold at 23.76. Okay, despite the fact that from June all the way to September there was a sell-off, it managed to bounce off at this 23.76 level, rebounded from here. And what you could see over here is now the key resistance will be at 29.36 level, 29.36. And why this index is important over here, take a look at it. Previously, during the November 2020, all the way up to June 2022, there was a big rally in this DBC. And this big rally in this DBC causes the US core CPI to increase as well, and as well as the headline CPI, right? And from August 2022 all the way down to September 2024, it starts to hover, right? It traded sideways over here. This is where it allows the core US CPI to actually decelerate, right? It's decelerate over here. Okay, so what if now, based on its past direct correlation with US core CPI and US headline CPI, if it starts to break out above 29.36, so this is the key technical level to watch on this DPC. If it starts to break out above 29.36, it's like a basing formation, and that could potentially lead to inflation pressure coming back into the US again. So there's a high probability that the core CPI in US and the headline CPI in US, right now it has been slowly deceleration according to the sideways movement on the DBC. But if DBC starts to stage a bullish breakout above 29.36, US inflationary pressure as depicted by the core CPI and headline CPI may start to rise again. So this is a very important chart, fundamental and intermarket analysis that I will share with you all. Is tradable commodities market, it could have a knock-on impact on the real fundamental of the US economy as being depicted by this intermarket and fundamental dynamics that is playing out right now. But this will not take part overnight. it will actually evolve over a longer term time horizon, a medium term time horizon, multi-week to multi-month. So when this thing happen over here, it could actually create a very volatile situation, especially on the major US stock indices. All right. So that is for the fundamental. A bit long today because of this important dynamics that's playing out and share with you. So right now, let us now focus our attention now to the short-term intraday technical outlook that only will last for 1 to 2 days. All right, 1 to 2 days. Okay, before that, let me expand my screen so that you guys could have a better view on the chart. Okay, good. So let us start with the FX market first over here. All right, starting with the euro dollar. Okay, so the euro dollar continues to manage to find support at the short-term pivotal support level that we highlighted yesterday, 1.0945. So still no change, still using 1.0945 as my short-term pivotal support to maintain that intraday bullish bias. And also, if you look at the current RSI has managed to break out from this descending resistance and now starts to shape a series of higher low and haven't hit the overbought level yet. So there could be a probability that there will be a short-term bounce on the intraday basis for the euro dollar after that sell-off in the last 3 to 4 days, right? The sell-off from the 1.12 figure level. So taking things one step at a time, next near-term resistance to level to watch to maintain this intraday bullish bias, 110 figure level, a breakout above 110 figure level may see a retest to 110.55, which correspond to this 50-day moving average acting as a resistance level, similar resistance level as well. However, if price action starts to break down below 1.094 short-term pivotal support level, then this particular intraday bullish bias will be invalidated to see the continuation of this corrective decline scenario to expose the medium-term pivotal support level next at 1.0890, which confluence with the long-term 200-day moving average. Okay, so that's for the euro dollar. Now, on the sterling dollar yesterday tested the 1.3070 short-term pivotal support level and managed to survive from that level over here. The hourly RSI also continues to shape a series of higher low as it's traded during the US session and into Asia session today. So still no change, still using the 1.3070 level as my short-term pivotal support, still maintain that intraday bullish bias because this level still holds, but I will have a shorter term resistance level for today, okay, to watch out for. That is actually yesterday's Asia session high, 1.3130. Above 1.3130 exposes 1.3160. So these are the two resistance levels to watch for today on the intraday basis. But however, if price action starts to break down below the 50-day moving average at this 130.70 for hourly close below it, then today's intraday bullish bias will be invalidated to see the extension of this corrective decline to expose the medium-term pivotal support level at 130.40 followed by 130 figure level. So this 130 figure level on the daily chart is pretty key. Is my medium-term pivotal support that I defined earlier. What's this level key? Because this is the pullback resistance of this former symmetrical triangle major range breakout. Previously kept the price action since 13th of July and it broke out on the August 2024, retested it on 11th of September, and now this will be another point of interest, this pullback support. If this level breaks, that means this major and medium-term uptrend on the sterling dollar will be in jeopardy. Okay, so that's how I derive why the 130 level, why is it key on the sterling dollar. So now with that, let us now focus our attention to the Aussie dollar. Still recall Aussie dollar yesterday, we do have a bearish bias. So the bearish bias hit our support level at 67.40. So upon hitting this support level, it actually tested the 50-day moving average in today's Asia session at 67.20, and we start to see a bullish divergence that's being flashed out so far on the hourly RSI as well. So given that it has managed to stage a retest on the 50-day moving average with this bullish divergence that's being formed on the hourly RSI, potentially we may see a bit of what we call at least an intraday bounce on the Aussie dollar. So with that positive element on the hourly RSI, we will flip to an intraday bullish bias for this bounce scenario to take shape, potentially using 67.20 short-term pivotal support level. Two resistance to watch over here on the intraday basis will be 67 67.70, which is today's currently Asia session high, 67.70. Above it exposes 68.10, which also confluence with the 20-day moving average, acting as a resistance. But however, if price action starts to break down below 67.20, then this corrective decline scenario will extend on the downside to expose the next near-term support level at 66.70, followed by 66.35, which correspond to the 200-day moving average, acting as a support level as well. Okay, now turning on our attention will be the dollar yen. So the dollar yen over here continues to actually slide as expected, holding the key medium-term pivotal resistance at 149.30. A quick recap: how do I define this 149.30? So over here, this 149.30 is being defined at this point in time. This former inverted V-shaped medium-term swing high that is being formed on the 15th of August and the 16th of August 2024. This is the daily chart. And if you do the Fibo retracement of the entire medium-term downtrend phase from 3rd of July all the way down to the low of 16th of September, it corresponds closely to the 38.2% Fibo extension as well. All right, so there's some reaction of this predefined 149.30 medium-term pivotal resistance. So given that it's still in motion, I do not want to actually tighten this key medium-term pivotal resistance so tight. Perhaps I could have a first near-term resistance level to watch for today over here. Okay, will be at least 148.35, but as long as the bounce didn't surpass 149.30, we'll still maintain the intraday bearish bias. For today, first near-term resistance support, first near-term support level to watch, will be 147.20. That was the breakout level that was being triggered on that exposed non-farm payroll data release. A breakdown below this 147.20 may expose the next near-term support level at 145.90/145.45, which is the 50-day moving average that is acting as a support level as well. All right, so that sum up the intraday technical outlook on the major FX cross pair. So that sum up the intraday technical outlook on the major dollar pair. Okay, so there's one particular FX cross pair that I will share with you all for today, will be the Kiwi yen. Okay, Kiwi yen over here. So this Kiwi yen, it has broken down this minor descending, former minor trend line support from the low of 16th of September, and now acting as a pullback resistance at 91.40. And previously, that rally managed to actually store at the 200-day moving average, acting as a resistance at 92.20 level. So now potentially there could be a bounce since price action has now exit from the overbought level. So as long as this bounce didn't surpass 91.40, this key pullback resistance level on the intraday basis, now acting as a short-term pivotal support at 91.40. The next near-term support level to watch on this Kiwi yen will be at 89.40, which is the 50-day moving average, acting as a support level as well. Only a breakdown below 89.40 potentially may see a deeper minor corrective decline to expose the next near-term support level at 88.60/88.40 level. So if we do the Fibo retracement to high, that also confluence with the golden ratio as well, 61.8. But however, if price action starts to break out above 91.40, then that will invalidate the intraday bearish bias on the Kiwi yen to revisit the 92.20 key medium-term pivotal resistance as well, which is confluence with the 200-day moving average. Okay, right. So that's for the one particular FX cross pair, Kiwi yen, that we may take a look out for. All right. Now, turning our attention will be the major major stock indices, starting with the Hang Seng Index first. So the Hang Seng Index, what's interesting over here is that yes, there's this sell-off over here, but this sell-off managed to find support at a particular support that we highlighted yesterday. So yesterday we do have a very tight short-term pivotal support over here at 22,320, looking for the price to bounce higher towards 23,550, but almost hit there before during the US session yesterday, before it collapsed right now during the speech of this NDRC speech briefing. So but seems to me that there's some kind of support that's being formed already as a bounce, and also the hourly RSI now has really hit the oversold level and looking to exit from it. So still maintaining that intraday bullish bias because this bounce that is taking shape using 20,880/20,590 over here, but it got to actually surpass fast at 22,320. That means this is the breakdown level that was being triggered this morning. So a breakout above this 22,320 will increase the odds of a continuation of this impulsive upmove sequence to revisit 23,550/23,670 next. But however, if price action starts to break down further below 20,590, then this mean reversion decline scenario may extend further to the downside to expose the next near-term support level at 19,790, which is close to the 20-day moving average. If this level can't hold, the next near-term support level to watch on the extension move on the downside for this mean reversion decline will be 18,230 next, which correspond to the rising 50-day moving average, and as well as the former minor swing high of 30th of August. So that's for the Hong Kong 33. Now, turning our attention will be the Japan 225. So the Japan 225, yesterday we do have a bullish bias holding above the 38,740 level. But given that the Japan 225 has a very close relationship with the major US stock indices and as well as the dollar yen that is now being showing further intraday bearish bias on the dollar yen. So I will not be so convinced of maintaining my bullish bias that we have yesterday on the Japan 225. So even though it managed to hold exactly at the short-term pivotal support that we have yesterday at 38,740, the conviction has been lowered due to the weakness on the major US stock indices, especially on the SPS and the Nasdaq 100 that has a close correlation with the Japan 225, and also the weakness that's being played out intraday on the dollar yen as well. So with that, we will have a neutrality stance for today on the Japan 225. So neutral between 39,370 and 38,740. Only a breakout with an hourly close above the upper neutrality limit at 39,370 will reinforce our initial bullish bias again to expose the next near-term resistance level at 39,790, followed by 40,155/280. Okay, so that's for the Japan 225. Now, turning our attention now will be the German 30. So the German 30, yesterday we do have a bullish bias at 18,960, which is the 20-day moving average as well. But price action yesterday failed to actually do a push-up and now starts to form a lower high instead. And doing the Asia session now is actually testing this 18,960. But overall, the RSI has started to turn bearish by this bearish breakdown of this former parallel trendline support. And it seems to us that this bearish breakdown indicates the lack of upside momentum on the German 30. So with that, there's a risk that this 20-day MA may not hold. So I will use 19,220 as my short-term pivotal resistance for today, looking for a bearish breakdown of the 18,960. A breakdown below this level exposes 18,690 and potentially even 18,510 next, which correspond to the rising 50-day moving average. But however, if price action managed to reverse and shape an hourly close and a breakout above 19,220, then today's intraday bearish bias breakdown view will be invalidated to kickstart another round of impulsive up move to revisit in first step the next intermediate resistance zone of 19,460/19,550. So that's for the German 30. Turning our attention now to the US Wall Street 30. So given that the lack of movement on the US Wall Street 30, so yesterday we do have a bullish bias on the US Wall Street 30, which is the Dow Jones Industrial Average at 41,950. Price action managed to test and help this level by the close. But given the lack of momentum, and if you look at the daily chart, is rather showing signs of cautiousness. So what you could see over here is that price action continues to remain flattish, a kind of flattish price action since the all-time high area that was printed on 27th of September. But your RSI has started to shape a bearish divergence, all right, on the daily time frame. So if this bearish divergence then being formed on the daily RSI, I'll be not so convinced to maintain my intraday bullish bias on the Dow Jones Industrial Average for the US Wall Street 30 that we have yesterday. So with that, I will actually flip to a neutrality stance, neutral between 41,950 and 42,440. So however, if price action starts to break down below 41,950, then that will validate intraday bearish bias move on the US Wall Street 30 to kind of expose the next near-term support level on the intraday basis at 41,535 in the first step. So that's for the US Wall Street 30. And now turning our attention now to the Nasdaq 100 over here. So the Nasdaq 100, what you could see over here is that it actually failed to actually maintain that 20,000 level and starts to trade much lower during yesterday's US session. And if you start to see the hourly RSI, the hourly RSI starts to print a series of lower high as well. So given us a bit of sign of a down intraday bearish momentum has resurfaced back again on the Nasdaq 100. So with that, first resistance level to watch will be 19,900. Then I will use slightly above the 20,000 mark over here. So this was the minor range resistance that was formed on 1st of October, 20,155. So using 20,155 as my short-term pivotal resistance level, flip to a intraday bearish bias on the Nasdaq 100. Next near-term support level to watch will be 19,630. That managed to help since 1st of October. A breakdown below it may expose the next near-term support level at 19,380, which confluence with the 50-day moving average acting as a support, and as well as this minor ascending, this medium-term ascending trend line from the low of 5th of August 2 months ago. Okay, so that sum up the intraday technical outlook on the major global stock indices. So now turning our attention now will be the commodities market, starting with gold XAU/USD. So gold XAU/USD still continues to actually hold at the 2,625 short-term pivotal support that we have since late last week. And now price action has managed to find a bit of support back above the 2,640 level again. So with that, still no change, still maintain 2,625 on gold XAU/USD, but price action got to break up above 2,674 to reinforce that impulsive upmove sequence to come back to then thereafter to revisit the next near-term support level at 2,692. Okay, so let me put it in writing over here. 2,674. Okay, so this is something like an upside trigger level that price action got to break, all right, to actually escape from this sideways range, minor sideways range configuration that has been in place since 27th of September. But however, if price action starts to break down below 26.25, it also correspond to this rising 20-day moving average as well, then we may kickstart a minor corrective decline scenario on gold XAU/USD to expose the next near-term support level at 2,590, followed by 2,570 next. Right. So lastly will be the West Texas crude oil over here. So West Texas crude oil on the daily chart over here, yesterday it managed to rally, hit our first, this is a day, yeah, this is a daily chart, hit our first resistance level 78.30. And very importantly, the key medium-term resistance level to watch will be 80.30. So, but the MACD is still trending upwards on a daily basis. So 80.30 is in fact this major descending trend line that is in place since 28th of September 2023. So if we start to see a clear daily breakout with a daily close above 80.30 level, this is a daily chart, then oil price may see further upside pressure towards 87 level, then thereafter the 90 level, 93 level range. So that could actually increase the risk of inflationary expectation picking up in the US and globally as well due to the rising oil prices, due to this ongoing hostility that's being depicted in the Middle East region. So what's cooking on an intraday basis? So still recall that on the intraday basis, yesterday we do have a bullish bias. So it really hit the 78.30 level and oil price starts to push down over here. So so 80, this is 78.30 level over here. Okay, so let me 78.30 level. So with that, I'll be using the 80.30 level mark over here because I don't put it so tight just to get a whipsaw. So using 80.30 level as my pivotal resistance for today on West Texas crude oil, we will flip to an intraday bearish bias for at least a intraday corrective decline scenario playing out on WTI crude oil, also supported by this bearish divergence that's being seen on the hourly RSI at the overbought level yesterday during the US session after it hit the 78.30 level mark. Resistance level. First support level to watch in this potential intraday bearish corrective pullback scenario, 75.70. A breakdown below it, revisit 74.20/73.15, which is this former minor resistance broken out turns into a pullback support at 73.15. However, if price action starts to break out above 80.30 level, then this impulsive up move may resume in the first step towards the next resistance level at 82.85, followed by 83.10 level mark over here, which is this congestion zone area, and as well as the 2 times Fibo extension and the 2 times Fibo extension from different lows, 1st of October low and 11th of September low. All right, so that sum up the intraday technical outlook on the broad-based cost asset classes. So before we go, what are the key economic data to look out for today? So for today over here is also a rather quiet. Okay, let me make sure that's let me reduce it, push up to 1 star to see is there other important thing to look at. So for today, there's also seems to be also a rather quiet. Okay, where is it? Yeah, over here. So it's a rather sorry, give me a minute. Why is it not showing up? Yeah, over here. Okay, so it's also a rather quiet European session today, except for industrial production in Germany that's out at 2 p.m. Singapore time, followed by a ECB official speaking, ECB Senate speaking at 3 p.m. Singapore time, and there's a Federal Reserve official speaking, Kruger at 3 p.m. Singapore time later. Today, followed by ECB Macau speaking at 6:15 p.m. Then we would rather have a rather quiet US session until we have a slew of US Federal Reserve officials speaking again. 12:45 a.m. Fed Bostic will be speaking. 4 a.m. Fed Collins. 7:30 a.m. Singapore time Fed Jefferson. So it's more like a Federal Reserve official Fed speak for today. What's interesting, before the start of our daily dose tomorrow, it will be the New Zealand Central Bank RBNZ interest rate decision that's out at 9 a.m. Singapore time. Market is expecting a jumbo cut of 50 basis points to bring it down to 4.75% from 5.25%. All right, so that should sum up today's daily dose of market insights. I'm Kelvin here signing off, and I wish you all a great day ahead, and we shall speak again tomorrow. Thank you.